or even an InfoEdge, which spends about 10 to 15% of their overall revenues on sales. So IndiaMart has managed to generate organic traffic without any advertising spend. And now it's no longer just a discovery platform or a classified, a Yellow Pages equivalent for B2B. They have now moved and evolved into conversational commerce, which means once you get on the platform, you like a particular product by a supplier, you can directly talk to that supplier and purchase it. So it moves on to commerce as well. And the company has been making investments, nearly 1,200 crore rupees since its IPO, to enhance its value proposition. So Equirus is forecasting a 17% revenue growth till FY28. That's from FY23 to FY28 with margin expansion. So the EBITDA growth is seen much higher at 28%. But the bell is about to ring and it's expected to be a very quiet start. The Nifty has opened up 17 points higher. The sensex up 20, 35, 50 points, absolutely flat. But the action is in the broader market. So the Midcap index is again going for itself. It's up close to about 0.4%. In terms of the big movers, let me start with the gainers list. UPL is the top Nifty gainer, a rally of 1.2% as the board approves a 4,200 crore rights issue. NTPC is in focus. Their renewable energy unit has won a bid for 900 megawatts of solar projects. So that's got the stock a bit higher in trade. You've got metal stocks, steel stocks, JSW Steel, Tata Steel opening higher as the dollar index has retreated to a 5-month low. So metals as an index is doing well. A couple of pharma names like Divi's, Apollo in the green, Apollo Hospitals. On the losing side, IT. In fact, the top 5 Nifty losers are IT names, led by Infosys with that MOU cancellation. It's a large one, $1.5 billion over 10 years. Stock is down 2%. Wipro sees some of its momentum fade. Last week on Friday, it gained 6.6%. Of that, 1.5% has been given off. Tech Mahindra, TCS, HCL Tech also down in sympathy with a cut of close to about 0.5%. But still very, very quiet on the frontline indices.
Midcaps, well, there's some flair and some activity over here. A couple of the PSUs are still running. That's a dominant theme. BEL, of course, also reacting to favorable brokerage commentary that the stock finds itself surrounded by. 2.5% up on BEL. Then you have some more names like Hindustan Copper, NALCO, MMTC. So basically the metals complex, particularly some of the PSU metal stocks, are doing quite okay today. You've got some momentum on TV18 Broadcast Network 18, the companies that run and operate the channel you're watching. Some news around, some buzz and news around potential deals over there. Then the other gainers would include an Adani Green. There's a lot of chatter around the board meeting where Adani Green could be looking at fresh fundraising, 2.5% up on that stock. Delivery is having a good morning, 2.5% up straight away as we start off. Castrol, Krishna, Medical, PNC Infra. These are some of the other stocks that are finding some takers early on in the morning. Otherwise, it is quiet, no denying that. But these are the early movers. RBL Bank, favorable news as the RBI appointed director's term finally comes to an end after 2 years. So that one's up and about as well. Some profit taking on Lemon Tree is quite evident, but Chalet Hotels on the other side opened out positive. Hotel stocks in focus as the holiday season rolls on. Speaking of holidays, Prashant, they're really quiet. At least the index is taking it easy as the week starts off.
No, absolutely. I mean, it's the index level absolutely quiet. But, at the broader level, there is, I think, a fair bit which is going on. So maybe look at, I think we guys mentioned BEL, Bharat Electronics, is the largest volume-led gainer with a 3% gain, but volumes are very large on this one. Balmer Lorry, I think, was limit up on Friday, and it's up another 4%. Usually it doesn't count as one of a big volume mover at the word go, but it is coming up as a third or the fourth largest volume-led gainer. JK, we were talking about Jaykumar, basically, JKIL, a 13% higher, 556 on that one. Again, coming up with large volumes. Castrol went up 6 or 7% on Friday. There is follow-through today with another 3% pop, 167 on Castrol. All cargo, there was, of course, that news flow which we addressed. 7% higher on all cargo, 328. Again, volumes are very large on that one. There is, I think you guys mentioned LT Foods, 5.5% on LT Foods. And again, I'm only mentioning it because volumes are large. TV18 Broadcast starts about 4.5% higher. Of course, the channel you're watching is, of course, owned by the company. There is Nesco, which is up about 5% or so. Nesco is, again, at about 900 plus. coming up with volumes. There is Yatra, which is up about 5.5%. I can go down the list, but then volumes are not that large. This is, what I mentioned, the 10 odd names. These are some of the large volume movers.
Kalyan Jewelers and Honasa, interesting consumer names.
Yeah.
Also finding takers this morning. So I guess Midcaps is pretty much where people are looking out for some action.
No, absolutely, looks like it. IRDA is another one, right? IRDA, I think, is down 5.5%. It's so there is a, I think it's a. But yeah, it's from the highs that we saw recently, which was 123. It's now just about around that 100 rupee level. So in about 4 or 5 days, it's given up about 20 rupees or so. And of course, I think Rima mentioned Infosys, which is down 2% now on very large volumes. Wipro, of course, continues to give back. It already came off the highs of that day on Friday. That day, the last 30 minutes actually came off quite a bit, and it's now down about 1.33% or so. The recent listing, Inox India, is also, it was a super 40% sort of pop on day one as compared to the issue price, but now it's down about 1.33%. The high on Inox Inox India, the day of the listing was 990, and it's basically given up 100 rupees from that point. And this is, I think, the third day as far as the listed life is concerned for that one. So more in a bit from now. But Harsha Upadhyay is joining us now. He's Chief Investment Officer, Equity at Kotak Mutual Fund. Harsha, good morning. Season's greetings from all of us here. Thank you very much for joining us. Good to speak with you as always. So this is that time of the year when you look ahead and make predictions, Harsha. So I don't know if I should ask you to go down that road, but I'm sure you thought about how the year is panned out and how the next year may look like and what could be the big sort of themes and trends. So if I could ask you to reflect on that, if you have, go on.
Good morning, Prashant. Season greetings to you and all your viewers. If you look at 2023, clearly it has panned out much better than what most people anticipated, and much better than what we anticipated as well. When you look at the markets now, I think the large caps are fairly priced in. If you look at mid and small caps, there is a bit of overvaluation there. So to that extent, I think earnings delivery going into 2024 will be very crucial for the markets to sustain these levels or move forward from these levels. In terms of investment themes, just because we are moving from December calendar to January, I don't think there will be change in our approach. We still like some of the themes which are medium to long-term themes. For example, all the capex beneficiaries are part of our portfolio. We continue to believe that order flows and investment cycle strength will continue to dominate, and you will continue to see good growth from entire basket. Yes, valuations need to be kept in mind, whether this theme or any other theme that we are positive on, as markets are fair to full valuations in many of the areas. If you look at other themes, I would say real estate and home building is another one where we have been very positive on. And we are also positive on financial services, although the segment has not done much in the recent times. If economy has to grow at 7.5%, and if there has to be a strength in the economy, then financials have to participate there. And we clearly see this as an opportunity, since the short-term performance has not been so great and ownership is also not so high. We believe that this could be a sector to watch out for in 2024. Apart from this, we also believe there are many areas where government has been focusing on investments, for example, railways, defense, infrastructure, etc. All of these would be focus areas for us in terms of our portfolio construction going forward into 2024.
So talking about the government themes, whether it's railway, defense, infrastructure, many of them have been ongoing or showing you positive momentum for nearly 3 years now. Which ones may have run its course, or the stocks may have priced in all the good news, and which amongst these PSU themes, whether it's banks, railways, defense, or infrastructure, still has a lot more legs? Where will leadership emerge in this PSU theme, according to you?
Rima, we don't actually differentiate based on the ownership. We would rather evaluate each of the businesses and the valuations separately and take a call on those. As far as the areas that you mentioned are concerned, I think many of them have been priced to perfection. So as I said, earnings sustainability from here on will be very crucial. For example, if you're looking at defense or railways, I think the order inflows and the execution should be focused upon, and the companies which are clearly ahead of the pack in terms of execution and getting more orders will be the ones who will sustain these valuations. And similarly, there are several utilities which are still okay in terms of valuations compared to, let's say, defense or railways. And we think that there is safety, relative safety in terms of those names.
Defense and railways. Harsha, hi, season's greetings to you. Surabhi here. I guess, this is pretty much the issue that people are grappling with, because it's more of capex, more of PSU. That's the dominant theme in the market. And then you try and wrap your head around valuations and entry points. Let's talk about the broader capex realm. I mean, whether you're talking about road contractors or EPC players, or even some of the capital good companies. How do you find these stocks given the run-up now?
So definitely most of these have done well in the past year and a half. So to that extent, I don't think you can say that valuations are very attractive. They are priced in most of the immediate upside, I would say. However, if you look at the next 3 to 5 year growth, most of these sectors and subsectors will exhibit strong growth. And within those sectors, the execution comes into play, and the companies which are good at execution without really stretching their balance sheets will be the ones which will really do well on the stock market. So to that extent, I think the uniform rally that you have seen in defense, railways, infrastructure, or any of the themes that we spoke about in the last few minutes is probably over. From here on, you need to be more stock specific. And 2024, as I said, since valuations are on the higher side as you enter, the earnings delivery is going to be very crucial. And especially for these sectors, it's going to be even more crucial, I would say.
Arshad, on the flip side, we're talking, of course, capex and infra on one end, and that's been the big theme in 2023. On the flip side, FMCG and basically, staples, the regular consumer, that's become almost a forgotten theme, a forgotten sector in the market. Do you see that changing in the new year at all?
It could be a dog horse at this point of time, while we do not see any green shoots at the moment. But over the next 2-3 quarters, assuming that the next monsoon doesn't disappoint, probably rural recovery will take some shape. And most of these sectors which are closely linked to rural economy have not done well. So to that extent, I would say that probably sometime in the middle of next year or the later part of the next year would be the time for some of these sectors to re-rate.
Okay. Anything, we, by the way, will be speaking with a chemicals company a little later after this interaction. Is that a sector you've looked at? It's not a very large sector, market cap wise, but you've got lots of representation, different kinds, from the, bulk to the specialty. And last 12 months, stocks have disappointed. One can argue that multiples have not derated, but much of the disappointment is coming from earnings. So I don't know which way this will go in 2024. Many believe that, PEs perhaps will get derated. Other believes, it's turned the corner. Any thoughts at all, Harsha?
Prashant, clearly within chemicals, we like specialty chemicals over commodity chemicals. I think the entire segment has seen destocking, and the price levels have come down and the margins have taken a hit. However, if you look at the medium to long-term growth characteristics of specialty chemicals, they are intact, and none of the managements have really cut on their capex guidance. They are continuing to invest into medium to long-term growth. So that gives us confidence. And also, we have been seeing a little bit of stability in terms of specialty chemical prices in many segments. And if that continues, probably we have seen the worst of destocking cycle, and we should see a little bit of improvement into next couple of quarters in terms of not only prices, but also in terms of margins. So that augurs well for specialty chemicals, especially after a sideways movement of maybe 4 to 6 quarters. So to that extent, I would say the valuations are not so high. And if things turn around, I think there is money to be made.
Okay. All right. Just a quick look back at what the market is doing, and then we'll go back to Harsha for more. By the way, market breadth is pretty solid, 2:1 in favor of advances. Not quite 2:1, but not very far away either. Let's look at GE Shipping if we can. There was some incremental news flow which came through, at least started to trickle through, that dire Suez problem and the consequent expectation that freight rates will jump, etc. News started to come through that large global shipping liners like Maersk, etc., once again are starting to send ships through the Red Sea route. So I think, we don't know, we don't have confirmation whether it's really begun or will try and do that for you, but at least at the margin, the news flow started to ease a little bit out there. Otherwise, I think the screen is not very different from what we mentioned earlier on. Few other additions. Mukund Limited is up about 4.5%. There is Surya Roshni, which is up about 5% or so. Some new additions to the list of gainers that we mentioned earlier. Look at Neyveli Lignite. I don't think this was in the mix early on. That is NLC India. It's 8% move, 241 on NLC India. And this is coming through in a very sharp way right here. Harsha, again, public sector, we discussed this earlier. Do you think from an institutional perspective, there's going to be a fair bit of money which goes in? There are PSU funds now, which perhaps, and maybe that is the way to go about if you want to still look at the public sector space. Instead of going after single stocks or trying to identify this theme, that theme, as you said, it's going to be much more stock selective. So just wanted your thoughts there.
Yes, as far as we are concerned, I think we would always look at business and the management and the valuations, and that continues. Within PSU pack, I would say probably the utilities is one space where valuations are still not so high, and also the growth is going to be a lot more stable and a reasonable dividend yield in some cases as well. So overall, I think it's a decent space to be in, especially given where the valuations are for the entire market in that sense. However, in terms of pure growth, I would say probably there are many other PSU-led areas, for example, defense, railways, infrastructure, etc., where from a medium to long-term perspective, the growth characteristics would be much stronger compared to utilities.
Okay, Harsha, we will leave it on that note for today. Good chatting with you as always. Thank you very much. And here's wishing you season's greetings once again and a happy new year in advance. Look forward to catching up with you in 2024 now. Well, let's move on and put the spotlight on Inox Wind. The wind energy solutions provider has won a repeat order for 279 megawatts for its 3 megawatt wind turbine generators from a large commercial and industrial player. To understand what this really means for the company and to talk about the outlook for the business going ahead, we have Devansh Jain, Executive Director at Inox GFL Group with us. Devansh, thanks for joining in. Season's greetings to you. So let's just start by understanding this. 279 megawatts for your 3 megawatt wind turbine generators. Typically over what period of time does this get executed? What is the revenue implication? And, where does it take your overall order book position?
Good morning. Thank you for having me with you, and a very happy season's greetings to all of you and your viewers.
Thank you.
So what we've announced today is a 280 odd megawatt order. It's a 180 megawatt pure play equipment supply with very limited scope, turnkey, services, as well as a 99 megawatt turnkey order. The thumb rule order value ranges between 7.7 crores to about 8 crores per megawatt for a turnkey order. So in order of magnitude, this would be an order win in excess of 2,200 crores. This is excluding the O&M piece, which obviously is a services business on an annual basis for the journey of the contract. In terms of order book, I think we were at about 1,276 megawatts as of 30th September. And I think with this order, our order book exceeds 1,550 megawatts. I think we have a huge pipeline of orders which we expect to close and announce over the next few months. And I think we aim to close FY24, hopefully, with enough orders to cover us for more than, not just FY25, but partly FY26 as well.
Devansh, okay, I'm just going over the numbers again. If I heard you right, you said the revenue implication translates into about 2,200 crores. That is X of operation and maintenance, right? Now,
That's
over
right.
what period and over what period of time is this booked, this 2,200 crores?
Look, so we've been given time until June 25 to execute both these orders, which are across Gujarat and Rajasthan. And I think we should start delivering, supplies as well as services for this contract from beginning of FY25. So maybe Q1 FY25 is when we should start execution of this order.
And once you add up the maintenance part of it as well, typically for a contract like this, what is the additional maintenance revenue that you can hope to garner on a yearly basis?
Look, so typically it ranges from 8 to 10 lakhs per megawatt per annum, which would, and that's from year 3 onwards. You typically give a 2-year free O&M period. But ballpark, I would say this would translate to about 25 crores of O&M revenue for our O&M subsidiary called Inox Green on a yearly basis for the lifetime of the contract.
What would be the revenue recognition? You've given us the order size totally. It starts in Q1 of FY25. But every year, how much would you be recognizing? Or what would it be? Would it be staggered? Give us some more color.
Well, I think it would be uniformly spread out across, let's say, a Q1 FY25 until, say, Q1 FY26, given that we have time until June 25. It's very hard to give a specific timeline, but these are rolling contracts. You'll keep supplying turbines. Obviously, commissioning is a little back-ended, but other than that, it should be fairly uniformly spread from Q1 until Q1 of FY26.
Got it. And you also said that from now, by the end of FY24, your order book, you're hopeful will cover you for FY25 and part of FY26. So the current order book is 1550 crore. In the next 3 months, what's the visibility of adding more orders, winning more orders?
Look, I think we have a huge pipeline of orders which we expect to close as we continue moving from now until, let's say, March FY24. I think what we've stated in the public domain, and I think basis a lot of the analyst estimates out there, we hope to do far better than that. I think, broadly speaking, what's already in the public domain, I think various analysts have put a target of about 2 gigawatts of execution over the next, in this financial year and 2 more financial years. But I think we are priming ourselves and gearing ourselves up at Inox Wind to get to gigawatt scale of execution in the near future. I think we've got all our balance sheet issues sorted. We've got the supply chain in place. We've got the manufacturing in place. I think we've rebuilt a very, very strong team now. And I think with the macro tailwinds with us, I think we should be far exceeding the numbers which are out in the public domain. Having said that, I think we from an order inflow perspective, as I said, we expect significant orders over the next couple of months. But I think there's a huge pipeline of PSU tenders which are out there. There's almost, I would say, 1.5 gigawatts of PSU orders which should be awarded out from now until, say, Q1 of FY25. And this is across players like NTPC, NLC, SJVN, and this is besides a lot of the CNI players we are already in advanced discussions for closing orders. So I think we're pretty hopeful that we should end FY24 with orders which cover a large chunk of FY26 for us as well.
Devansh, hi, morning. The big sort of number which everyone has been fixated, and rightfully so, has been the 10 gigawatt number, right, every year for the next few years. So that's the flow, at least what we can expect. So what's your share of that? I mean, or is that, I remember we had a word with Suzlon a couple of I think 2 months back, and they said, well, before in the last cycle, they used to have about a third of the share of tendering at that point in time. I mean, just trying to understand, where are you at already?
Look, historically, when the sector was rolling, we were typically about 15 to 20% of the Indian market. Having said that, I think what we prime ourselves up for is profitability. I don't think we are so focused on being the largest. I mean, we are one of the largest. We're probably the top 3 players in the Indian market. But I think in terms of profitability, we are way ahead of everybody else. So I would rather focus on profitability rather than just trying to be number 1 in terms of volume. Within which I think we probably have one of the strongest balance sheets in the sector. We probably have the highest promoter holding in any other wind company owned by an Indian in the Indian context. We are probably the only, we are the only A-rated wind OEM in the Indian market. So frankly speaking, I don't think it's a question of volume. I think the kind of order inflows we're seeing is phenomenal, and I think we're priming ourselves to ramp up operations. As I said, if you look at a lot of the analyst estimates out there, we're really going from, say, 100 megawatt a year for the past 4 or 5 years when the sector was shut down to virtually now, or say 700 crores of top line now to about 4,000 crores of top line in the coming financial year. Look at the various analyst estimates. I mean, it's multifold growth which we expect, and I think very, very profitable growth. So I don't want to get fixated on market share. I think I would rather be fixated with profitability, where we're the lowest cost producer.
So give us some. Give us some numbers on profitability. Where are you at? Where will you go from here in terms of profitability numbers, margins, for example, in 25 and 26? Just a roadmap.
Look, I think what we've guided for is in the coming financial year, we should get back to our historical EBIT numbers, which were typically about 15%. So I think we're well on track for that. And I mean, currently the sector's just turned around. Everyone's getting back. So I don't think you would be able to make out much from the numbers in the public domain. But what we also said was every quarter would be better than the previous quarter over the course of this financial year. So in Q1, we turned EBITDA positive. Q2, we turned cash PAT positive. Q3 and Q4 are coming up. So God willing, we should keep getting better and better.
Okay. So on profitability, actually, I was looking at one of the brokerage notes that our colleague had shared with us, ICICI Securities. They're expecting earnings of 440 crores in 25 and 650 crores in 26. Do these numbers ballpark sound, accurate in terms of projections?
I think we should be doing far more than that, God willing.
Okay, fair enough. Devansh, finally,
I think, Devansh, how much? Far more. How much better you think? I mean, if you can share any broad numbers without going into specifics, yeah.
Look, I think let me try and answer that qualitatively. Look, if the market is going to be, say, 8 to 10 gigawatts in FY26, I think it's fairly easy to assume a 15 to 20% market share. Now, if you put those numbers and juxtapose that into an 8 to 10 gigawatt number, you would get a volume of almost 1,500 to 2 gigawatts, right? So I think from the numbers out there in the brokerage report, I think we could be way, way, way ahead. But look, yeah, I think let's see how the market moves. I think, as I said, we're priming ourselves up for gigawatt scale execution. And, God willing, I think we should be doing far better than what's in the public domain.
Devansh, thank you very much for joining in. Happy New Year. Your shareholders have indeed had a good year. The stock is up 350% in the last, this year itself. There you have it. In 1 month, it's up 75%, but 12-month rally stands at 350%. We will get into a break. On the other side, in our special offering, the big winners of 2023, we'll be joined by Himanshu Baid of Poly Medicure to talk about business momentum and the setup for 2024. Mitesh Thakkar will also join in to decode the charts on the markets and several counters. Stay tuned.
CNBC-TV18, embarking on a quarter century of excellence. CNBC-TV18, embarking on a quarter century of excellence.
Welcome back. Flat for the markets, and markets are flat despite banks not doing anything. Banking index is just up 11 points, and the IT index being down 1.25%. What's offsetting the weakness in IT are the PSUs once again. The Nifty CPSC index has a gain of 1.4%, and throw in metals and autos, which are up close to about 0.5%. But talking about stocks, and one of the big winners of 2023 is Medicure. Stock has surged 60% this year. In fact, for this year, FY24, the company has further raised their guidance to 20 to 24% and 25 to 27% on margin. Himanshu Baid, Managing Director of Medicure, is with us on the show. Mr. Baid, thank you very much for joining in. Can you give us an indication of how Q3 has been for you and the visibility for Q4? In the first half of the year, you were anyway tracking growth above your guidance at 26%. Now that we're almost done with Q3, do you have the visibility to beat your guidance for FY24?
So I think I would say that we'll be on track to deliver the growth which we have promised. And I think when the new plants go online, and I think two of the plants already gone online, 2 more would be ready by end of this current financial year. So we will have no added capacity, and probably that will also take us further to do a growth in FY25. So we'll stay on track, what we have committed.
Right. Mr. Baid, hi, good morning. Give us a sense of the size of the opportunity for you. Is it just about capacity? I mean, you are already the largest, maybe also the most profitable medical equipment company out of the country. What is the size of the opportunity? And 70% of your sort of revenues are exports. In terms of the number of products that you're in, the SKUs that you have, at this stage, what is the size of the opportunity for you as you look into FY25 and beyond?
So I'll divide the bucket into 3 parts. One is India. So I think in India, we see the healthcare industry going around 12 to 15%. And I think medtech would go much faster. So here we see a growth of maybe around 20 to 25% or even higher as we get into more hospitals and as we go deeper with our relationship with existing clients. So India, probably we have covered 1/3 of the market right now. So 2/3 is still, which still needs to be covered. And we are trying to aggressively, pitch ourselves in that zone. When we look at exports, I think US is just opening for us. So that's a bigger opportunity for us going forward in the next few years. Europe is 1/3 of our revenue. So Europe continues to be a very big opportunity for us. And I think we have seen a tremendous growth there. I think in first 6 months, we have grown over 30% in Europe. And I think that trend should continue for next years. So overall, I think exports looks pretty good, and so does the domestic market. And the size is quite big because domestic, as we just heard an announcement from Honorable Union Minister, Mr. Mandavia, that the industry is going to go to around 50 billion from a current 15 billion. So by 2030. So that's a big, big market, which is going to open up for manufacturing, exports, and also, domestic market is going to grow at a very high speed.
When you said for India, you addressed 1/3 of the market. You mean you are in 1/3 of the hospitals? I mean, you have relationships with 1/3. That's what you mean?
Yeah, that's what I mean. That's what I mean.
Okay. So, import substitution, make in India, these have been big themes which the government is encouraging in a very large way. Now this is one sector which I believe perhaps should be ripe for it, right? Because this is also a very large area of import, I would imagine. So,
yeah,
but do you have? Are you present across product categories, or are you? Will you have to expand and innovate a lot more?
No, I think we'll have to expand and innovate a lot more. But currently, we have a good position in our infusion vascular market or renal market or transfusion. So we are also getting into now cardiology and critical care. So these are 2 new segments which we announced this year, and we would get deeper into these segments also. So the market's quite huge. We still have probably neurology, urology, gastroenterology to cover, and in that space also there are consumables used which cut across the current product range we manufacture today. So there's a lot to do actually in next 5 to 10 years. a lot of areas to grow, a lot of products to make in the country. So a lot of opportunity exists for actually everyone.
Mr. Baid, hi, good morning. I just want to get a sense of the margin profile, not in the near term, not the next 1-2 quarters, but more from a medium term, perspective, and what we can really expect, given that you are present both, in the international markets and the India market, and your business is far bigger, internationally. So how does pricing work? Do you get better pricing in your overseas export markets? Also, as we look at more product complexity, more launches, what is the expectation? Can margins move northwards of this 25 to 27% band that you've been guiding for so far?
See, I think when we look at international markets, the cost of doing business is slightly lower for us because we don't have too much feet on the ground outside India. So it's more B2B. So here we have a better margin profile. But when you look at India, so we have around 350 to 400 people on the ground. And also they are going to hospitals and promoting the products there. So the cost of doing business in India is slightly higher comparatively. But I think as time progresses, as we get into more value-added products, I think we will see some improvement in margin going forward. I can't guide it right now, but because we are in the development phase of 2 new divisions, which are going to be very, very critical for the company going forward next 4 or 5 years. But in my view, we will continue to stay in that 25 to 27% zone for next few years.
Can you tell us more about these 2 new divisions, the 2 new critical divisions that could perhaps be margin accretive as well?
Yeah, so basically cardiology is something which we're getting into, is intervention cardiology. So a lot of products, catheters and guide wires, and which are used currently imported into the country. So that is what we want to manufacture here. And also there's a great potential to export these products out of India. So that's where we decided to get into this business. And later on, we will also get into more structural heart and other things going forward. So that's one area we are focusing on right now. And the other area is critical care. And basically, these are products used in intensive care units. So we have seen that the percentage of intensive care units have increased post-COVID. Most of the hospitals were probably working at 10% ICU beds, now between 15 to 20% ICU beds. And I think there also we see a lot of potential. And we are developing devices to cater to even the critical care segment.
And when will the revenue from cardiology and critical care start accruing to the company?
I think from the next financial year. So
FY25.
So we are in the initial launch phase, but in FY25, we should be able to see revenues coming from these 2 divisions also.
And the number of devices that you're launching for, say, cardiology and critical care, what would be the overall size? What would be the market that you are initially targeting in FY25?
So the market size in India itself is around 1,000 crores for intervention cardiology products, which we are going to launch. So we're going to probably start with 5 to 10% market share in a couple of years, and then that's how we're going to grow the business. And critical care is also around similar size, but I think the bigger opportunity is even for exports. So once we have our regulatory approvals for exports to Europe and to other markets, I think that is where we're going to see a big ramp up. And probably that would happen.
Okay, and how long does it take for you to get the regulatory approval to go ahead and export? So your products will be ready for sale, say, the end of, say, March, April of, 2024, so you can sell it in FY25. But how soon before you can export?
So I think typically these are all critical care class 3 devices. And, it takes almost 1 to 2 years to get, EU approvals and, other approvals for other critical markets. So we think that in 2 years, we should be able to start exporting these products to regulated markets. Unregulated markets, probably we could, which is probably India and around, Southeast Asia, which is fairly easy to get in, probably we'll start exports and maybe by end of 25.
Just 2 more questions. One is, sorry, I think you mentioned a margin number. Can you repeat that? And growth for the next couple of years, what should we expect on the top line?
See, we have not guided for FY25, so I'll refrain from that. But I think we have seen the momentum already in FY23 and 24, and hopefully we'll continue a similar momentum, going forward, because we have invested in a lot of new manufacturing infrastructure, and I think that is going to help us to, continue with that current momentum which we have of around 20 to 22%. I think that will continue with that momentum.
20% revenue growth and margin, sir? Where
So
would
margin
that be?
between 25 to 27% is what we are guiding actually. And I think that's the momentum which we are seeing right now. And I think that momentum should continue.
And just one thing, US is the big one, right? Where you're just getting started. And that is the most profitable medtech market, of course, as well. You got approval for 2 categories of infusion therapy products there. So what should we expect? I mean, it's going to be a very slow ramp up because how difficult is it to crack it? Do you have the sales team there on the ground? Do you have, everything going there?
So we have developed B2B relationships in the US market. We are working with some large companies there. And I think it's a start. And I think we've just got FDA approvals last quarter. So I think we have just shipped few products and we are waiting for market to react to those products. And once, we get more visibility there, I think, and we are probably also applying for 6 to 7 products more for US FDA. And we hope to get them by end of 24. So totally the basket would have 8 to 10 products. And I think that will become a significant play for us in the US market going forward.
Okay. All right. Got that. We will leave it on that note. Mr. Baer, thank you very much for joining in. Good luck with your plans. And we wish you a very happy, prosperous and progressive 2024. Thank you for joining in today.
Thank you very much. Thanks. Same to you guys. Thank you.
Thank you. All right, back to the market, and it's not looking too bad, actually. The frontline indices are also now trying to stabilize with a little bit of gain, 30 points up on the Nifty. Midcaps are actually roaring away, almost 0.75% rally on the midcap index. So it's slow and steady and picking up steam. The only problem area for the market really is IT today. Frontline IT is where the cuts are. Otherwise, things are quite all right for the time being. Well, with that, it is time for our special segment, Charting Trends. We have Mitesh Thakkar joining in to give us a more medium-term technical outlook and how one can be approaching the market given the levels where we are at. So, Mitesh, sort of fill us in. It's been an absolutely phenomenal rally. December has been a blowout month. I guess a lot of people are wondering whether this should just be expected to continue. How do you approach it from here on?
Good morning, Survi. I think this rally will see a few more higher highs. So I think in that sense, it's a good market to be invested into. From a trading point of view, you might want to adjust tactically, but from an investment point of view, I still believe that there is good amount of upside left. The Nifty getting past 20,200 was the breakout beyond the earlier highs. Now that should come in as a medium to long-term support zone. So therefore, I think there is about 4-5% kind of a downside which might happen, but I think eventually we are looking at much higher levels from here in the coming few months. So the idea is to remain invested. I've identified a few stocks. The first one of them is Bear Crop. I think, if you look at the long-term charts here, since June of 2020, the stock has kind of tested these levels of 55.20, 55.30 on multiple occasions, not getting a monthly close above that. Now, this month, while we haven't had the monthly close, we are still about 3-4 days away from that. The position of the indicator suggests that the breakout should happen and the price is already above this 55.30 zone. So my sense is that this stock is now heading towards 7,000 plus. Would recommend accumulation at current levels and keep a stop below 52.25. And as I said, the first target is around 7,000, gives you roughly about 25% kind of an upside.
You also have Castrol. Just last week, we were talking how Castrol for the last so many years has always been in a maximum range of 160 to 162. The peaks for Castrol every year hasn't been beyond 162, but today it's broken out. Where does the chart go from here on, according to you?
So, actually, it's been about 8-9 years that the stock has not had a monthly close above this 165, 170 zone. I think now the signs are there that it should happen this time. So I would believe that, once that breakout happens, the stock is heading towards a minimum target of 220, but a possible extension target of around 250. So I think it's a good stock to accumulate in the next few weeks between this range of 170, 150. The moment we see a monthly or a weekly close above 170, I think the stock should start accelerating higher and make, and head towards higher levels. So keep a stop below 135 here and accumulate in the range of 170 to 150. As I said, I'm looking at a target of around 250, roughly about 50% kind of an upside from here.
You got a view on Deepak Nitrite as well, Mitesh?
Yes, Shant, good morning. Another stock, which has been in a very tight sideways kind of consolidation. If you look at the last about 24 months of history, the stock is doing a range of about 2450 to about 2200. And now I think it's showing signs on the long-term indicators, which are now turning up after this 24-month consolidation, is now showing signs of a possible breakout. So again, a stock which I would recommend accumulating currently. Once it starts getting past this 2500 levels, then I think I would look at a minimum target of around 3300 over here, and keep a stop below 2145 for any long positions or stocks which people might buy.
Okay, and you've got some more stocks on your radar, like Nalco. Tell us.
Disclaimer here, Nalco is also part of my portfolio, so I have vested interest. But again, the stock, has completed what typically technicians would call as a rounding formation. It made a high of around 108, 110 a couple of years back, went down to as low as about 65, 60, and then has again come back and has completed a saucer formation. Yeah. So it's now given a breakout about that. So accumulate within this range of 118 to 108, which was the earlier high, and keep a stop below 104. And I think this breakout of this pattern suggests a target of around 150, 150 to about 155 on the upside.
Okay, by the way, it's 10 o'clock and there are 3 new listings that will be debuting on the Lal Street today. The first one is Muthoot Microfinance, Rural NBFC. The second one is Suraj Estates. And the third one is Motisan Jewelers. Now, Motisan Jewelers, amongst the 3, had seen the most subscription. It was a 400 crore fresh issue with an overall subscription of nearly 160 times. And it's listed, Muthoot Microfinance. Muthoot MFI has absolutely had a flat listing. Suraj Estates has opened with a cut of about 7-8%. So it's a tepid opening for Muthoot Micro and Suraj Estates. Both of them are down 7%. On listing, but Motisan's Jewelers, which had seen a fabulous subscription, has straight away off the bat opened with a gain of close to about 90 rupees. The stock is at 105 versus the issue price of 55 rupees. While for Muthoot Microfinance and Suraj Estates, even the overall subscription was muted, like 10-15 times compared to what we've seen in the past. The stocks have opened up on the weaker side.
Yeah. It's slightly lower, as Rima said, for Muthoot. And we had, by the way, we've spoken with all the managements, leading up to the IPOs, during the IPO process, etc. as well. So the listings, I would say on expected lines, in line with what subscription numbers, etc. looked like for all 3, Muthoot, Suraj, and Motisan's Jewelers. By the way, you'll hear from, companies, because with the listings now done, managements would be able to sort of guide ahead in terms of what numbers for financial guidance, etc., would look like, which they were reluctant to, of course, during the time of the IPO. So that's what we have at this point in time. Let's just go back with the market, which I think has actually got a leg up. We're, I think, at the high point of the day with the Nifty up 50 points. So it's a 0.25% gain, and it's not bad at all. So 21,400 is back on the screen for the Nifty. Look at that sharp spike which has come through. And I think the Nifty Bank, no real help from the Nifty Bank, which has come up a little bit, but nothing. So let's just take a quick look at where this is, where the push actually is coming from. On the Nifty, there is help from Hero MotoCorp, which is at the top of the gainers list with a 3% gain. There is NTPC, which is up about 2% or so. There is Divi's Laboratories, Coal India, and Adani Enterprises, which are up about 1.8, 1.9% as well. So, yeah, that's a rundown. And of course, on the downside, it's basically the tech Trimurti. There is Infosys, HCL Tech, and Wipro, which are the top losers, but nothing large. 1%, 1.5% kind of cuts is. And there's actually Tech Mahindra and TCS, which are a little weaker as well. So that's what's coming through.
And midcaps, the midcap index is now racing towards a near 1% rally, 400 points gain on the midcap index. So that's the market, which is very vibrant. But let's get you some stocks which are in the move. The first one is UPL. Sonal had highlighted the stock in top 10. She'd spoken about the rights issue. For more details, let's go back to her. Sonal.
Thank you so much for that. Well, yes, the stock is in focus because a big fundraise has been announced by the company to the tune of 4,200 crore rupees. This is via a rights issue. Now, remember, the company has been seeing high level of debts and the industry in general has not been doing so well. And UPL had also done a buyback back in March 2022 at around 800 rupees a share. And the market prices come off from those levels, around 30% from those levels itself. They had cut their FY24 guidance in terms of revenue and EBITDA as well. They are expecting EBITDA to now decline versus the growth that they had expected earlier. So clearly they are in need of funds. Their debt had increased as well, and second half usually does see higher debt in terms of working capital requirement. They spoke about higher inventory destocking, higher debt issues, so maybe that is something that they are planning to address with this fundraise. We'll get to know more details in terms of pricing, in terms of the number as well, but yes, it is a big fundraise that the company has announced and it is in focus on the back of that.
Okay, thank you very much for that. Infosys is the other one which has taken the biggest knock today as a global customer has terminated a large $1.5 billion MOU with the company. Infosys had announced this MOU in September. The hope was that this MOU will translate into an actual deal, but that contract has now been terminated. In fact, Infosys has been an underperformer versus the rest of its peers. So year to date, Infy has gone up 1.5%, while the IT index is up 22%. And we were chatting with Sandeep, and he said, this news coupled with the fact that there have been some senior level exits, the latest one being the CFO who's announced his decision to step down. And in the last 15 months, we've had the two presidents leave the company and join peers like Tech Mahindra as well as Cognizant has hurt the company. This entire crunch down on discretionary spending has resulted in the company lowering their full year guidance. When they started this year, FY24 in April, they had guided for a 4 to 7% top line growth, and now they're looking at a just 1 to 2.5% top line growth. So there have been multiple reasons why this stock has been an underperformer versus peers, and now this is the latest about that contract, an MOU getting terminated. But there's TV18 too.
Oh, absolutely. News reports indicating potential M&A and corporate action. Mangalam is tracking a lot of these reports that are doing the rounds. Mangalam, fill us in.
Well, for news reports, they suggest that there is a big deal in the works. This is between Reliance and the makers of Mickey Mouse, Disney, for their India operations itself. Disney and Reliance, as per those reports, have entered into a non-binding agreement for a merger of the Indian operations of Disney's business, which includes Disney Plus Hotstar. And Reliance Industries of this merged entity will hold about 51% stake, with 49% held by Disney itself. This deal, as per those reports, again, will likely be in the form of a combination of both shares and cash, and is likely to be completed by Feb 2024 itself. Of course, all of this is between Reliance, Disney. The impact could be felt and is being felt on the media arms of Reliance, which is TV18 and Network 18. They announced a merger earlier in the previous week as well. But all of this, of course, with the disclaimers that TV18 and Network 18, as well as Reliance, are the companies that own the channel that you're currently watching.
All right, Mangalam, thanks very much for that. Stock's doing well. Now, Ola Electric has filed its DRHP, targeting an IPO early next year. This is the first public offering by an auto company in the last two decades. The first pure-play electric vehicle company to list on the exchanges. The company's revenues went up sharply to 2,630 crore rupees from 373 crores in the last financial year, that is FY23. The company is looking to raise around 5,500 crores via the IPO. Parikshit is here. He's gone through the DRHP with some of the highlights which stand out. Parikshit, over to you.
Well, yes, Ola is looking to raise 5,500 crores through this IPO, which it's targeting early next year. Bhavish Agarwal, the promoter of Ola Electric, is looking to sell around 4.7 crore shares via OFS. The IPO itself altogether has 9.52 crore shares. Out of this 5,500 crores that Ola Electric is looking to raise, 1,264 crores will be used for the Gigafactory, 800 crores for debt repayment, 1,600 crores for R&D, and 350 crores for organic growth initiative. The company has been consistently improving gross margins from 5.4% in FY22 to 7.63% in FY23. But of course, there are issues such as liabilities. Total liabilities as of June 2023 are at 3,600 crores versus 3,217 crores as of FY23 end. The loss for Q1 of FY24 is at 267 crore so far, and the FY23 loss was at 1,472 crore, up from 78 crore in FY22. Revenue is up 8x to rupees 2,631 crore in FY23. In terms of future plans, the company has outlined that a large amount of this fundraise will go towards fast-tracking EV manufacturing and its gigafactory for cell manufacturing, which is likely to be operational in Krishnagiri, Tamil Nadu in March 2024. They will use these cells for their own electric vehicles. And in terms of future product launches, they want to begin deliveries of Ola S1X 2 kWh, 3 kWh scooter by H1 FY25. They will commence deliveries of motorcycles in H1 FY26. They want to expand the product portfolio to cover mass market motorcycles and want to launch affordable mass market scooters and motorcycles in various segments. Interestingly, no mention of the car plan here. They are sticking to scooters and motorcycles for now, sticking to the two-wheeler segment and cell manufacturing.
Okay, Parikshit got that. Thank you very much. And thanks for the financials as well. This is going to be an interesting one. Let's see if the public markets will have the appetite to digest the kind of losses that Ola right now is still sort of, dealing with, and whether they can provide more clarity on the whole road to profitability, which is what the stock markets love to hear more about. Thank you very much for the details. Watching out for this big one. We'll take a break on that note. On the other side, back to commodities. Manisha Gupta will give us the highlights of today's trading action.
CNBC-TV18, embarking on a quarter-century of excellence. CNBC-TV18, embarking on a quarter-century of excellence.
Welcome back. The Nifty is building on gains. Now it's 21,420. Just in 5 minutes, we've added about 20 points on the Nifty, while the Midcap index is up close to about 400 points. But let's talk commodities. Manisha is here with us. Manisha.
Thank you for that, Reema. I'm looking at metals because that is the best performer within the non-ferrous metal space there. We are looking at 4.5-month highs when it comes to the copper prices there. It's up 8% since the month of October, but for the year, it's up nearly 2% for 2023. This is going to be an annual gain for copper after last year of decline. But this is the only metal really that actually is looking at gains in comparison or in contrast to other metals there. Well, we are looking at supply disruptions. This is going to be a deficient year for the metal, and there is restocking in China that seems to be beginning now, and that is supportive for the metal prices there.
Well, apart from that, there are mine supplies also being reported in Latin America. There are statements from Anglo-Americans suggesting that they are going to be cutting output to the tune of nearly 3% of what the global supply of copper is. And that is going to happen in 2024. That has been supportive. It also is about statements coming in from Vale, Rio Tinto, all of these other producers also, which have cut production guidance for 2024. Markets also are looking at the other metals which have seen a decline. So whether you look at zinc, aluminum, nickel, these have seen a decline anywhere between 5 to 25% on the weaker side for this year. So clearly, copper is emerging as the best performer within the non-ferrous space there. This is going to be, by the way, a second straight year of decline for the other metals into the tertiary there. If you look at the positions on LME, CME and Shanghai, I mean, these are the three major exchanges in the world. They have moved on from net shorts to net longs, telling you that the hedge fund buying also seems to be supportive of where the fundamentals are standing at this point. If you look at the outlook for 2024, well, that is on the bearish side. Currently, copper is trading at $8,600 a ton. Fitch expects it to slightly come down, and an average of 8,300 is what they're looking at. JP Morgan and Bank of America are talking about 9,000 to 9,750. Citi is the only one that believes that in next 12 months, you could be looking at an all-time highs in case of copper, $10,000 to start with, but they also have targets at 12,000 and 15,000 going forward. Just to tell you that copper's all-time high till time has been $10,700 a ton. So while most don't believe that copper will touch that in the next year, Citi clearly seems to be more bullish than them.
Okay, Manisha, thank you very much for that. That's Commodities in Focus. We'll take a quick commercial break here, and we'll be speaking with an interesting company, Updater Services. Balaji Swaminathan is CFO of the company. We talk about what the business is all about with them. IIFL Securities have initiated coverage on the stock recently. Stay with us.
CNBC-TV18, embarking on a quarter century of excellence. CNBC-TV18, embarking on a quarter century of excellence.
Welcome back. Well, let's talk about, as promised, Updater Services. That is the company, that is the stock that we're going to discuss. IIFL Securities has initiated coverage on the name Updater Services. They say it's a buy, and they have a price target of 418 rupees. The stock's at just under 350 right now. Now, since listing in October, the stock, of course, is up about 23% or so. And IIFL, of course, believes that in the space that it is in, which is integrated facilities management, there is a lot of room to grow. They actually cite a report by Frost & Sullivan, which puts the company, Updata Services, the number 2 facilities management company in the country. We have Balaji Swaminathan, Chief Financial Officer of the company, joining us to talk about the business. Balaji, great to have you with us here. Good morning. Thanks very much. Prashant this side. So, very briefly, if you can run us through the activities of the company. There is integrated facilities management, and then there is something called business services support, that segment as well. Which the second part, which is the business support services, that is a slightly higher margin. The IFM, integrated facilities management, is low single digits in that sense in terms of margin and profitability point of view. Just the landscape, Balaji, of the business.
Yeah, good morning, Prashant, and good morning and a very happy Christmas and a New Year to all the CNBC viewers. Thanks for having us on this show. Right, look, as you rightly said, broadly we are a business support services platform. Right, and with 2 broad segments. One is the IFM, which is integrated facilities management, which basically covers the soft services, hard services, maintaining infrastructure facilities. We maintain certain airports, Statue of Unity is maintained by us end to end, right? So these are the facility related services which are there, and that is almost contributing about 70% of our revenues. And business support services has got various niche sub segments within that. So the larger one is the sales enablement that we have, which is more providing end-to-end sales related, the BD related services for various clients, where Microsoft is one of our larger clients on that space, right? And
so what do you? So what do you do in that? I mean, the sales enablement. I mean, with a simple example, if you can tell us.
Yeah, so it can range from initial strategization, planning of which market does the brand or the company or the client wants to target on. And from there, we take it up, strategize it. And from there, we get the leads who are the target audience for that, and then get the qualified leads from them, who would spend, who would not spend using AI, and also based on
so this is market research, is it, Balaji, if I understand?
It's not market research. It is more closer to execution of the strategy of the marketing that companies have. Say, for example, Microsoft needs to sell, say, the cloud related services, right? So then they might have a target in a particular segment or a particular country that they need to look at region. Then within that region and the target audience, we would be able to identify and then look at who would be spending, and similarly also look at what kind of spends that they have done in the past. So get that intelligence and then provide that kind of leads to the company so that they can sell and close the deal. So that is a way. So it can range from strategization. I also have field on staff who can go and then work depending upon the industry. Say we work with Shell. So there we work with their distributors. So this is a kind of, I would say, the top of the pyramid in the business support services, where the margins are much higher. And this is more revenue related. So that way it gets that prominence when we interact or partner with our clients.
So in IFM, which is 70% of your revenues, margins are about 5-6%. And on the business end, it is 20% plus margins. But that is only 30% of your revenues right now.
That's right. So the EBITDA margins will be closer to about 13 to 15% on the BSS side, and about 5% EBITDA on the IFM base. And both the segments, so apart from this, we also have employee background verification. Then we do the audit assurance, which is more for the retail segment. Then we have niche logistics. Then we also have ground handling services on the BSS side. And now coming on to IFM and BSS, both the businesses are in the growth markets. So the F&S report is also very clear what is the kind of growth that these two segments are growing at. And historically, we have grown above the market growth, and we expect to do that. So we should grow continuously, say for the next couple of years, closer to about 18 to 20% on both the segments equally. So in that sense, the mix should more or less remain stagnant, maybe a few percentages here and there, but otherwise it should remain stagnant unless otherwise any acquisitions are being done in the BSS space. As we mentioned earlier, we will not look at any acquisitions in the IFM space.
Okay, so both IFM and BSS should continue to grow at 18 to 20%. What would your market share in IFM be? Is there any way to look at it on a consolidated basis?
Look, on IFM, what happens is market share might be a very small number, which should be closer to about 2.3 as per the F&S report. But again, the way to look at that market is the market is more fragmented with a lot of unorganized players. So the comparables, if you look at it, maybe there are about 7-8 players who are there who would control about 15% or about 15 to 20% of the market share. So out of which 2.2% is for UDS. So this is very clearly depicted in the F&S report. You can have a look at there.
Got it. And how quickly is the market share moving to the organized players from the unorganized? You're saying the organized players largely have a market share of 15%. What is the growth rate of the organized market in IFM versus unorganized? Because as the pie increases, even your IFM business should go up, even if you don't gain further market share.
That's right. So look, I think even this is clearly targeted there. So I think from about 50 to 53% of unorganized, which is there, very small unorganized players, this segment should come down to maybe about 30-35% by 2027. So that is the market research report states. F&S, right? So, but also we also need to look at that when the scale needs to come in from unorganized to organized. When you look at it, so unorganized players are controlling very small pieces, and those pieces have to get consolidated so that it can benefit the organized sector like us, because we are there on the top. So our target is more larger spaces which are there rather than very small offices and other places where the unorganized sector is doing. I think for us the growth, yes, some part will come in from the unorganized to organized. And the larger part of the growth will come in from the India growth story, where we have a lot of infrastructure facilities being set up, and that gives us a stronger hold because we are there in the manufacturing as a larger chunk. About 30% of our IFM revenues come from manufacturing, and with the Make in India and China Plus One concept, so there are a lot of facilities that are coming up. So that gives us a larger growth space. And similarly, the infra that is being built, be it airports or large complexes that are being done, so that gives us the space to grow.
Mr. Swaminathan, finally coming back to Business Support Solution, BSS, which is where the bulk of the profitability really comes in from. That's 30% of your business right now. What are the plans? Give us a view, say a year or two out. To what extent can you grow it to say 35-40% of the business, and which are the key sectors or industries which could be driving the BSS growth for you?
Sure. So look, these are very niche businesses that we are in, multiple sub-segments that we have, but they are leaders in their specific space. Say, for example, in sales enablement, Denave is our subsidiary, and Denave holds the position 1. And similarly, on the employee background verification, maybe we are at 3, and audit and assurance, we are again at 2. So these are very niche positions that we hold in BSS as well. So that way it helps us to project it to our clients. And again, the bigger part is the kind of clientele that we have on both sides, IFM and the BSS. There is a lot of cross sell that is possible, right? So that is more internal synergy that we have, where as of now the contribution from the cross sell is very minuscule, and we expect that to grow. So that is one more from internal, where we try to look at the existing customers and offer a large bouquet of services. And second, coming to the specific industries, right, the specific segments that we operate in, these are niche, and there is a large headroom that we can utilize to move ahead. And pretty much today, if you look at on the sales enablement space, it's more 2 sectors that where we are very prominent. One is on the IT/ITES, and the second part is on the BFSI. And these 2 segments, BFSI is a growth story that is going through, so which should help us out. And similarly, on the IT/ITES, though there is some stagnation, but again, this being revenue related, people are staying invested into these services so that as and when the market moves up, they should be able to take advantage of that. And similarly, on the background verification space, we are more IT/ITES dependent. And there we had a setback compared to last year, where the growth and the profitability has declined because the hiring in IT/ITES has slowed down, right? So that way, that is already captured in the current year numbers that we have. So from here, we expect this to move further upwards rather than going down, because we think that we have already hit the bottom at that place in terms of hiring, right? Yeah. So that way, that should help us out. Well, And of course, the global flight handling is the other piece where we have about 20 airports that we have concessions for the next 10 years, and only partially we are operational there. So that should also give us a growth story from there, from the base where we are standing today. So in that sense, it's a combination of both internal synergies that we have, and similarly the industries that we are working in, and the services itself will provide us the path, the runway for.
Got it. Balaji, we'll leave it there. Interesting conversation. Had a few more, but we'll have you back to talk more about this. But I think this is a good place to start. Thank you very much for joining us and running us through what the business is about and some of the key drivers for the business as you see it from here out. So that's Updata Services, facilities management company. There are others listed out there. I mean, which include companies like SIS, maybe to a lesser degree TeamLease perhaps. I mean, some of the businesses overlap with what Updata does, and a few others as well. So that is the company in focus. The market is at the day's highest point from the last. So it's the index was up 50 points at the day's high. It's added another 30. So we're up about 85 points on the index. So after a full 1.5 hours on Bazaar, we are at the high point, and it's a good-looking screen. The Nifty Bank is also up 180 points, about 1/3% or so is where we're at. It's a wrap on this edition of Bazaar from all of us here. Goodbye. Thanks for watching. Chartbusters will pick up on all the action forward. Stay with us.
CNBC TV18, embarking on a quarter century of excellence. CNBC TV18, embarking on a quarter century of excellence.
Infosys slump.